Welcome everyone to this very special ETRise webinar on the recent moratorium announced by the Reserve Bank of India. This is an unprecedented situation, and the RBI responded a week ago by saying that to mitigate the burden of debt servicing brought about by disruptions of COVID-19 pandemic, and to ensure the continuity of viable businesses, they felt there was a need, to come out with a moratorium for businesses that might have a temporary disruption in cash flows, and in some cases even loss of income. So this is supposed to be a temporary measure to bring relief, but it may seem pretty plain Jane that this is what you don't have to pay a EMI on your loan for 3 months. But if we look closely, there are several issues that one needs to take into account before we go for a scheme like this. And to discuss this and more, we have with us today Sanjay Doshi, partner, Teal Advisory Financial Services, KPMG in India, and Alok Mittal, co-founder and CEO, Indifi Technologies. Good to have you both here, gentlemen. And first, let more people join in. So let's just get opening thoughts on the scheme. Sanjay, if I can come to you first, what are your thoughts on this?
Sure. Thank you, Pran, and good afternoon, everyone. Yes, I think RBI came up with the scheme close to a week back. This is primarily measures to extend liquidity to the corporates, and they have come up with threefold measures, right? One is from their own side, they have actually given more liquidity to banks. The second element is they have actually come up with measures where banks can onwards give liquidity in form of moratoriums, and to a certain extent also incremental credit, especially on the working capital side, to the corporates. And the third key thing is none of this moratorium or credits will have any impact on the status of the borrower account in terms of whether it's going to be considered as a default account or a delinquent account. So it's a three-pronged strategy which the Reserve Bank of India has come on the entire liquidity measures. And of course, then they have left it for the individual or the respective bank's board to come up with their own policy of how they want to really implement it, the kind of borrowers they want to extend this moratorium or incremental credit facilities. So that discretion has been left to the individual respective banks and its board. They've really not come and given a blanket kind of a moratorium to the entire market or the corporate world or the industry. So these are the key salient features, if I would really like to put it that way, on the scheme. So yes, on one side, the liquidity really helps, but the thing is it's a 3 months moratorium, and that moratorium is primarily on the installments or loans or interest which is going to be due between the 1st of March 2020 till 31st of May 2020, and to an extent even then there is a incremental extension on the tenor of the loan by 3 months because the repayment cycle gets rescheduled by 3 months. So broadly, it's a great 3 months liquidity measure, but I'm sure given where the state of this entire economy is today, the global economy, the Indian economy, and as we speak, we don't even know how long this situation is going to last. So whether these measures will be adequate enough or something incremental which will really come from an RBI perspective is something to watch for.
Right. Alok, what are your first thoughts on this?
So I resonate with Sanjay. I think overall it is a positive measure. It does the job of getting liquidity in hands of borrowers, whether it is corporates, whether it is small businesses, whether it is retail borrowers. And it's a recognition of the fact that in a lockdown kind of a situation, pretty much everyone loses their revenue streams, and hence they may not have the ability to service their loan obligations. I also agree with Sanjay that I don't think we have seen the full story on this. No one really knows where we will be in a month or 2 months' time. and hence whether this measure is sufficient or not will only be known as the story unfolds. But at this point, I think we are seeing a lot of our customers come back and avail of the moratorium facility, and that just provides one affirmation of the need that exists at this point in time to be able to defer cash flows as much as possible.
So Sanjay, if I can come to you, while on the principal part of it, the moratorium looks good. You don't have to pay an EMI for 3 months. What are the fine prints? When should a small business or a company go for it? When do you think we should not go for it?
Well, the straight answer is that definitely if you believe that there is a cash crunch, you need to straight away go for it. There is nothing you need to wait for, because this moratorium is only for this 3 months, whether you avail it now or you don't avail it, right? But I don't think the answer is going to be as straight as I have put it across, right? I think because the key element is it's only the moratorium on the cash flow side. So you can delay your repayments by 3 months, but the interest element and that continues, right? So you keep on paying the interest on the loan, and that something is nothing but increasing your debt. So companies, corporates, even individuals who have taken individual loans should go back and have a proper assessment of that cash flow. And that is definitely a very, very detailed exercise. As we speak, we have been working with some of the corporates, and we have been in fact challenging many of the promoters and their CEOs, because they believe that, oh, we have cash right now. But have you really done scenario testing? Have you really looked out that, okay, fine, is the lockdown going to last till 15th of April, and will business come back to maybe not usual, but let's say 80-90% of the usual level in a couple of months' time? You see lockdown probably being extended, and hence the entire cash flows or the business economy getting impacted a lot. So each individual business and corporate, based on its ecosystem, needs to really work out a couple of scenarios, in fact 2-3 scenarios, through which they understand their immediate cash requirement in midterm and mid to long term, and based on that they need to plan whether they should go for the moratorium or not. Because straight away, in fact, just opting for the moratorium may also not be a great idea, because you need to go and service the interest on the principal payments or on the loan amount. At the same time, if you don't opt for it in this 3 months, you're not going to get this chance of at least shifting your cash flows by at least 3 months after 31st of May.
Right. Alok, you are from the lending community, so you have a view of the other side as well. When do you think a person should go, or a business should go for it, and when should they not?
So I think it is important to understand that this is not a waiver of interest. Neither in how RBI has announced it, nor in how any of the lenders are going to implement it. So the 3-month moratorium comes at a cost of 3 months of interest on whatever the current principal outstanding might be. Different lenders are also looking at different ways of ultimately realizing that interest. There are lenders who are saying, I'll keep the loan tenure the same and just move it by 3 months, which means that there'll be an increase in the EMI. We are seeing many more lenders who are saying we'll capitalize this interest, and that may translate into certain additional EMIs to be paid at the end of the loan tenure. And depending on the actual tenure of the loan, if you take home loans which might be 10-year long, that can mean a few more EMIs being added to the end of the loan tenure, not just one. For shorter tenure loans, it might mean one EMI, or however much amount is due being added to the end of it. So I think businesses and individuals need to look at what that cost ends up being for them. The reality is that working capitals will shrink during this time period in any case. Working capital requirements will shrink in this time period in any case, because business will not move as fast as it was moving earlier, and it will take time for that business to come back, right? So this is not a scenario in which one should assume that we don't have anything today, let's hold on to the money, but 3 months from now we'll have roaring business and Hence, all the working capital will get deployed. There is scenario planning to be done of saying, okay, what if for 3 months business is very subdued, but even in the 4th month, it is 40% of the business that you were doing. And obviously the scenario planning will vary, the impact will vary from industry to industry. In that scenario, how much working capital do you really need? Actually, on the working capital side, the RBI notification also does talk about the bank's prerogative to reassess the working capital cycles as well as the margins to be able to adjust the cash credit lines that might be available. So I would not be surprised if in cases where the bank does see that the industry is heavily impacted, they may not just look at the interest deferment on cash credit lines, but even start to constrain how much of the cash credit line remains valid.
Right. So Alok, you mentioned something interesting where you talked about loans where probably the tenure is coming to an end. That would make more sense. Primarily, is it because when you've taken a loan, the interest component keeps going first as EMI? Will that be a way to look at things where if you have loans for, say, an extended a period of time, say for 10 years left, that might actually work out to be a little harmful?
Yeah, the overall cost will be higher. It is all, end of the day, it's the time value of money, right? So suppose there was an incremental interest of 20,000 rupees in these 3 months on a certain loan, right? That 20,000 rupee, most lenders are saying they will capitalize at the end of 3 months, which means that converts into principal. And if it's a 10-year loan, then for 10 years, interest is accruing on that principal as well, right? So it's not just 20,000 rupees that needs to get paid, right? That depends on how the lender is including that interest repayment. If they are increasing the EMI size itself, then the tenure remains the same, but you are progressively paying it off. But if all of that is bunched towards the end of the loan tenure, in 10 years time, even with the best interest rates, you're looking at 2.5 times of the money to be paid, not just the interest subsidy, interest deferment that was offered.
So would you suggest that businesses and entrepreneurs actually sit down with their lenders? In this case, sit down is not possible, but reach out to their lenders and have a discussion on how best to cope with the situation?
Absolutely. And I think the good news is that given that this is a focal initiative as far as RBI is concerned, a lot of lenders have reacted with the due agility as well as transparency in these matters, right? So most lenders have one template as per which they're going to deal with this whole program, rather than introducing complexities inside it. So it should be relatively straightforward for borrowers to approach their lenders and understand what that accounting template is and what is the total impact that this has in terms of their interest accrual, but more importantly, how is that treated and what does that mean in incremental payments in what horizon? So I think that those discussions need to be had.
Right. So Sanjay, if I can come to you, when you talk about scenario building and looking at different scenarios, so I'm a little confused with the part that, okay, fine, at the moment you do not know what's going to happen 3 months from now. So should you hold on to the cash that you have, or you say, okay, fine, let's just continue paying the EMIs because, again, you have all this interest component built into it and stuff like that. But again, on the flip side of it, you do not know what's going to happen after 3 months, if the economy is going to come back on track, or it's going to be the same. Isn't this a very difficult scenario to build?
It is. And again, there are two parts to it, right? What Alok was mentioning, and I'll come back to the scenario analysis part. One is the moratorium part, where most of the banks have actually laid out their FAQs on the websites and have given clear-cut instructions of what they plan and where they plan to give the moratorium, and whether you have to opt in specifically or you have to specifically opt out of the moratorium scheme, right? Which is the easier part to deal with. And that's where I don't see many interactions really happening unless some clarification in terms of, okay, fine, what is my rescheduled tenor on home loans, etc. Term loans is, getting shifted by 3 months. The challenge comes is, okay, what is the working capital credit going to be for the business guys? And that's where probably this entire scenario analysis is going to come and play the picture. So do we believe, okay, fine. So first of all, no one can in today's time can rightly guess, or I don't know if they can actually come close to what's really going to happen as well, right? So you go with a worst case scenario, a base scenario, an upside scenario, like how you prepare in any business plans, and prepare for a worst case scenario as well. So somewhere you have to be, be close to base case scenario, but have backup plans ready on the worst case scenario. Number one. Number two, even on while during the scenarios, it's not that every corporate is going to get that extension of credit or working capital. I think that's where the entire interaction, which Alok mentioned, has to happen with the individual respective bankers of what the bank's plans are in terms of extending that credit, how much percentage of excess working capital credit they are going to be. So for example, without naming any banks, I read on a particular public sector bank website where they have actually come up with proper guidelines on the level of extended working capital credit they plan to give. So you would definitely then get a sense of, okay, this is the potential credit, which is what is available as an option for you if you plan to go for it, right? The third scenario, third way also for looking at it is, okay, fine, if you're still not sure, you want to wait for one more month, wait for a month, go for the moratorium, take that 1 month's interest cost, which is a hit, no doubt, but it's a cost you pay to somewhere mitigate your risk on the loan. And then after that, if you believe that, okay, you are comfortable on the cash flow, you can still pay your loan. It doesn't mean that the banks will not allow you to come and repay your loan and you have to take the entire 3 months of deferment. So again, each individual, each borrower will have to take this call, but there are options available for the borrowers and they will have to think through those options.
Right. Alok, if I can come to you now, from the perspective of a lender, what are some of the things that you would want to see from your borrowers, and what are some of the things that may be an area of concern for you?
Yeah, so I think the biggest concern at this point is to be able to discern where the disruption in the borrower's business might be coming because of the COVID-19 situation, and be able to differentiate that from where there is inherent stress in the business. Right. So one clear guideline that is available there in the RBI notification is that any accounts that were overdue on the 1st of March do not qualify for the moratorium, right? Because those accounts, at whatever stage of delinquency they were already stressed before the COVID-19 situation stuck, right? But at our end, we are doing a more detailed determination of that for our borrower base, right? So we are going industry by industry to say, which are the industries that are affected by the situation versus not. We have certain monitoring data that comes to us for every customer. We are looking at that monitoring data to be able to discern on a per customer basis as to how much is the business affected because of the COVID-19 situation. So the effort is towards ensuring that customers who are genuinely affected by this situation do get moratorium. It is in their interest that they do that. It is also in our interest that we provide them with the moratorium so that that stress does not translate into our books till such time that the customer's business has had an opportunity to recuperate. But equally important for us is that customers where there is stress due to other factors, they are not, those accounts are not delayed by 2 months in terms of our ability to act on them, to collect from them, or for those customers to have an opportunity to have a more fundamental restructuring of the loan if their erstwhile payment track record has been fine. So triaging the customer base into customers who are predominantly affected by COVID-19 versus customers who have a structural issue with their business versus customers where there is just a declining intent to pay. I think that is one problem that we are thinking about as we go out and roll out the moratorium.
Right. So Sanjay,
I think, Ron, just to add here, I think it's a key point Alok raised, right? I think think about it from the lender's perspective, I'm sure they will be getting so many requests, so many applications on the entire incremental credit side, right? And that's where a corporate who's really thought through his working capital cycle, one is of course the overall volume of the business may go down, but at the same time the working capital cycle itself will become longer, right? So what is the real impact in terms of the absolute amount of working capital? How are you really going to show the backup of inventory, receivables, maybe some kind of collateral which may also be required for an incremental credit to be obtained from your lenders? I think whoever is better ready also gets a better chance, right? So I think those kind of proactive measures and thinking, if people can start doing from now, will really help them in terms of having those conversations with their lenders.
Right. So Sanjay, if I can come to you, one question which keeps getting asked by all our readers, and not all, maybe most of our readers, is why do you have this interest component in the moratorium? Why can't we just do away with the interest part of it? And most, are pretty confused as to, what kind of relief is this if, the interest keeps applying?
Well, very difficult to answer this question. Means I think on one side, even the banks, 3 months, so someone has to take the hit, right? Whether it's going to be the lenders, so effectively the lenders passing on to the probably the deposit holders then, or where is the money going to come from is anyone's question. Is the government going to come up with any kind of additional measures? There was one thought process, can there be some kind of a subvention scheme given by the government, right? So a lot of conversations, discussions are happening. There is another conversation which is going around, that is this package enough, or is something more due from the government side, like how some of the other countries in US, London or Singapore, the kind of package they have come up with. So yes, I think if something comes in the future in terms of incremental package and some benefits coming to the customers, yes. At the same time, a complete interest moratorium from the financial institution side to all the borrowers is also think about, right? Then every borrower in this entire country is going to go for this moratorium. Who is not going to go for this moratorium? Then how is the cash flow going to really be managed by the banks? Because the bank also will have a back-to-back cash flows, or NBFCs will have back-to-back cash flows to be managed. So I don't think it's a pragmatic situation of no interest during the moratorium. But at the same time, can there be additional measures coming in from the government? Maybe yes. I'm not sure about it, whether the government is thinking about it or not. But yeah, that's one element which people can think about.
Right. Alok, would you want to weigh in this?
Yeah, the reality is that whatever money is outstanding today, it's not just that lenders like us will charge an interest on that. We are also paying the interest on that, right? So this is not money that was available for free and has been lent out, but we have a cost of borrowing, which still needs to get paid back because we are paying that money, or we are getting a moratorium on that money. So it's a back-to-back. The question is, as genuine in my mind as saying, why do I still have to pay for milk? Right? In these times, I should not have to. And sure, at some level, you could make a case for that, but then someone has to foot the bill. So it's not a free commodity that lenders are lending out and making money. There is, like any other business, there is a cost of goods sold in financing business.
Right. So another question which keeps getting asked, and both of you can tackle that, is around credit cards. Does this apply to credit card? While I think the answer now is yes. Should one go for it, especially because a lot of small businesses uh, and the entrepreneur, where they closely linked to the business, they use their credit card for business use as well. So in that sense, there is no division between their personal expenses and say a business expense. So in this case, should one go for credit card? I mean, should one go for the same scheme on the credit cards? Sanjay, if you want to come in first.
Yeah, so on credit card, I think credit card is one of the most expensive form of borrowing anyone can take, right? Because the interest on credit card dues is close to 2.5% to 3% per month, right? Now, again, my first suggestion and recommendation will always be that if you are in a situation to repay your debt, you should repay. I don't think you should go for the moratorium. number one. Number two, if you are going for a moratorium, then weigh in your various avenues of borrowings and then go for the moratorium for the least interest where it is. Now, credit card comes in the most expensive bucket, right? So the third element is, if you are just unable to pay cash, then probably you don't have a choice but to go for the moratorium. But think about it, it's very expensive because the interest cost, unless the bank, and they may want to check with their lender that if they have come up with a reduced interest cost on that particular credit card of theirs. If not, then the cost of interest is going to be high, and that's what the borrower should ideally weigh in before taking that decision.
Right. Alok?
No, I think Sanjay put this well. A credit card is the highest cost. In credit card, in any case, there is always an option of paying the minimum balance due and, in effect, carrying forward most of your balance. The reason you don't do it is because the interest rates are very high. And that same argument will apply here. To the extent we have spoken to credit card companies, they are still continuing with their fees and payment charges. And what that would imply is that the higher cost will continue to apply on balances that are carried forward. So yeah, being able to triage your loans into what costs you more, where the tenure is more, where the penalties and fees might be the least. That's a good way to look at the portfolio and see what you want to do. I must say that most of the term loan lenders out there are waiving off any sort of penalties on their own account because they understand that the customers are faced with a stressful situation. So when there is a moratorium, none of the penalties are applying with most of the lenders.
Right. Another question that comes pretty often now is, supposedly a business goes for the moratorium. Will it reflect somewhere in his account in a way that if he wants a further credit in these circumstances within these 3 months from, say, any borrower, is there a chance that he will be rejected because he's already applied for a moratorium? What is the sense?
Yeah, so I think there is a formal plane of this discussion, and there is a underwriting plane of this discussion, right? So on a formal plane, these accounts will be reported as normal. They will not be reported as overdue accounts. And to that extent, the credit bureau will carry a current status on these accounts, as long as once the moratorium expires, the customer continues to make them the payments in time, right? Otherwise, it will go into overdue at that point in time. And to that extent, bureau scores and the like should not get affected because someone availed of this moratorium. All lenders will also report these accounts to bureau as being current on payment, because fundamentally the payment plan has changed, and hence there is no overdue status on the renegotiated payment plan. On an informal basis, lenders will take calls on how they read into the moratorium, right? So at the most permissive end, if there is a customer who has just taken a moratorium and comes to us to take another loan in 3 months' time, we will question whether the customer has an ability to pay or not, because the fact they took the moratorium indicated an inability to pay in current times, right? So there is an underwriting leg of that where there might be more scrutiny, especially in the short term till such crisis continues. I would imagine that once we are outside of this crisis, then people will see moratorium as something that was out of control and out of normal behavior of these customers. So I don't anticipate a long-term effect, but yeah, in the short term, lenders who are looking at new loan applications from the same customers would rightly look at these moratoriums and assess the customer's ability to pay on the loan more closely.
Sanjay, you would want to come in here?
Yeah, I think just to add what Alok said, what's crucial is not this 3 months. What will be crucial is after this 3 months and the moratorium period gets over. So at least the way probably the lenders may look at it is that, okay, how the customer's behavior has been post completion of the 3 months moratorium. So even if they've gone for the 3 months moratorium, I'm sure the weightage to that probably in their analysis will be less in terms of underwriting. They may not really give much, but yeah, what's happening on the 4th, 5th, 6th month and after that. Are the repayments on track? Has the borrower shown the same kind of good trends of repaying his loans, principal, servicing his interest? Then it's going to be a normal as normal business as usual for the underwriter. But after the moratorium, if there is a bit of a delay or the leverage really goes up, or the business cycle has gone down because of which your coverage ratios are going up, so those kind of things will definitely have an impact on the underwriting.
Right. So as the questions keep coming, one common thread that I can notice in some form, it is the same thing where people say that what if I want to pay? So it's a 3-month moratorium where people say that I want to pay the first month as usual, but the second and third month I might go for this moratorium. Is that allowed in some form? Can you come in later or what? What is it?
So, the RBI notification provides the space to do this, but they do not mandate whether a particular lender will do it or not. Again, if I take our example, we are allowing our customers to come in and take a moratorium later in the cycle. So, for example, the RBI note is 1st March to 1st June, but by the time the scheme got announced, many of our customers had already paid their March EMI. Right now, in those cases, we are offering them a 2-month moratorium instead of a 3. And if there's a customer who comes back to us on the 20th of April after having paid the April EMI, we will still offer them the opportunity to take a 1-month moratorium. So again, check with your lender. Different lenders are dealing with this differently. There are obviously a class of lenders who are treating this as an opt-out, which means that everyone gets a moratorium unless the customer does not consent. And so their way of doing this might be very different from someone like us who's treating this as an opt-in.
Right. So in terms of where you were mentioning that there might be already one EMI which has already gone in through the ECS mode or whatever it might be, is there a way to claim a refund?
No. So I haven't heard of any lender who's giving back EMIs that have already been collected. And I think let's go back to the principle behind the moratorium, right? The moratorium is fundamentally aimed at helping borrowers whose repayment capacity has got compromised because of the COVID crisis, right? So that is the intent. So if there was a customer, and our EMI cycle dates are 5th of the month. So if there was a customer who was doing fine on 5th of March, paid their EMI, and started to see stress around 25th of March because of the lockdown situation, for example, right? There would be very little merit in going back and refunding that. The objective of the moratorium is not to pump in additional working capital or put money in hands of people. The objective is to empathize with the stress that their business might have come under, which would have compromised their ability to pay back the EMIs.
Right. Sanjay, we cannot hear you. I think you'll have to just re-plug in the mic. No. We could hear you. Yeah, we can hear you now.
Yeah, you can hear me now?
Yes, we
Yeah.
can.
Okay, sorry. What I said is that I have a couple of lenders where I have seen a refund application also, which can be given by the borrowers. Now, how much the lenders are really go and are going to give that refund is another element. So it's lender to lender, and I think so one has to go back and check with its lender, go on the website of the lenders, because most of the lenders have a good FAQ on their respective websites. And if there is a refund option available, you can go for it. But again, as Alok mentioned, the principle is a moratorium to be given when you are short of cash. If you already paid it, then you are not short of cash because of COVID, right? But again, it's a cash flow issue, which is not a short-term issue, it's slightly short to mid-term. So people can reassess of whether they want to go for the refund or not, subject to whether their lender permits it or not.
Right. So a lot of other questions. So let's go through them one by one. Vinod Sharma says, credit card limit due for renewable now. Loan under stress, bank pressurizing to convert in NPA. Last year's sale is below than expected, not supporting to the limit. Expecting this year good sales. How to tackle with bank? I am not very sure about the question. Anyone can try.
Okay, let me try to take a stab at it. I think from the sense of the question, if you all are already, there is an overdue, right? Then only the stress account question comes in. Then only the question comes of bank saying it's an NPA renewal of limits. So it seems like the account is already under stress. There are overdues on this account. And if there is an overdue on this account on 1st of March 2020, then the chances of this moratorium being given by the banks is pretty low, right? So it doesn't come under the scheme primarily. It doesn't come under any of the liquidity or COVID impact measures. And hence, and in fact, the life actually becomes difficult for many of the NPA accounts and SMA1, SMA2 accounts as well, because most of the lenders probably will not be extending moratorium, number one. And anyways, whatever dues which were there as of as of 1st March 2020, that will anyways follow the normal asset classification norms on accounting of NPAs, which means that they need to regularize those overdues, right? So for those set of borrowers, definitely life becomes much more difficult because they will also be impacted as like others by this entire COVID issue.
Right.
Some of the lenders are providing an option that, let us say if you were short of one EMI on 1st of March, then they're allowing the option of saying you pay that EMI, so bring your account to being current as of 1st of March, and then there is a 3-month moratorium that could be made available. So again, these policies vary from lenders to lenders, but that might be one opportunity to look into.
Right. So Krishna Kamal Das has said, how will banks respond after 3 months of this relieving period?
I think we spoke about that a little bit, right? Depends on how the borrower behaves after these 3 months, really. And is the business back on track? There will be a fresh assessment of the business and the borrower's ability to pay back whenever that new request for credit goes in.
Right. Vishweshwar Bhovi has said, does this provision belong to private companies or government companies?
So this liquidity measure is applicable to corporates. I don't think there is any distinguishment between private or public companies. But the option of who to give is at the lender. So it depends upon the lender's policy of who they want to give this moratorium.
Right. So there's one question which has come in which says, please put some focus on cash credit or bank overdraft. How is that going to get impacted?
Sanjay, you want to take that?
Sure. So on cash credit and bank overdraft, there are two elements. One element is the servicing element, which is the interest element. So on the interest portion, there is a moratorium where you may not want to pay interest for this 3 months. That interest will get accrued, and that accrued interest will need to be paid immediately post the moratorium, which is in the month of June 2020. So it's more of a liquidity issue which has been targeted at. In terms of the limit itself, also the Reserve Bank of India has gone and told the bankers that they have an option to look at the drawing power limits and reduce the margin which is required for the drawing power limits, and hence there can be potential incremental drawing powers depending upon the inventory and the receivables or the working capital levels which the borrower may have. So to that extent, there can be a potential incremental credit which can be given to the borrower based on its working capital cycle.
Look, you want to come?
No, I think Sanjay covered it well.
Okay. So Kishore Deshpande says, okay, so not really pertinent to what we are discussing. Ask, please inform where to get extra credit from. to make regular expenses? So very
Those are
valid
low.
question. We've got a lot of these questions. I can see it's completely filled with, although it doesn't pertain to, I mean, if anyone wants to answer, it's fine. Otherwise, move into the
Most lenders in these kind of environments will tighten their credit policy and not loosen them, which means it's harder to get new credit today than it was 30 days back. Most businesses, regardless of what sector they're in, are also seeing deterioration of business. Right? When a lockdown happens, almost no one wins. And to that extent, the business's ability to raise capital, debt capital today, is worse off than it was a month back. So given both of those, I think raising a fresh debt is going to be much harder. If I look at our own policies, about a third of what would pass our filter a month back would pass our filter today. Right. So that's just one example of how much the filters are getting constrained, and we know of lenders who have just stopped all disbursements at this point in time as well. So that's the range that one is playing in. The set of lenders you would go to are still the same that existed a month back. But I think fresh capital is going to get constrained a lot towards businesses that are still managing to do reasonably well and have great credit behavior in the past.
right. Prabhakar Shetty says NBFCs sanction the term loan on floating rate, and when the repo rate increases by RBI, NBFC increases the rate of interest. When the repo rate is reduced, NBFC says they are not bound by RBI. So that is not a question. I think that's more of a statement. The second part to it is, due to COVID-19 crisis, what would be the percentage of decrease in rate of interest?
Percentage of?
Decrease in ROI.
Being charged by the lenders.
Yes.
Yeah, no, so across the board, we are actually seeing an increase in ROI, right? So there is a risk premium at this point, which is kicking in. Any lender who's giving out fresh loans understands that these are troubled times. No one knows where the bottom is going to be, and hence they're inherently taking more risk giving out fresh money in this environment than they would otherwise. So situations like this will get a risk premium to kick in, not a discount. So I actually don't know of any lender who's doing that. There are some specific schemes that have come out. So for example, SIDBI has come up with a 5% scheme directed at businesses that are helping in fighting the COVID-19 situation, right? So if you are a business that manufactures surgical masks, for example, then there is a specific program that they have come up with on subsidized interest rates. But other than that, for normal business, most lenders are building in a risk premium given the uncertainty in the environment.
Right.
Fran, sorry, just to add here, I think one element I missed out mentioning, which is part of the measures, is where Reserve Bank of India has allowed banks to invest in investment grade plus bonds of corporates and classify them as HTM securities. And for that, there are certain liquidity measures, I think up to 1 lakh crore kind of a liquidity measure, which has been provided to Reserve Bank of India, to the banks from Reserve Bank of India. So the banks have an option to actually give incremental credit. Most likely it will go to their existing borrowers only. I don't think new to bank credit is something any bank will go for. So that is one avenue. If you are a rated business, rated company, your paper is rated and it's an investment grade plus, that's an option you may want to evaluate with your lender to really see if they can invest that, and that gets classified as an HTM security for at least 3 years, which gives them a nice liquidity period as well. So that's one element actually I missed to mention as part of the regulation.
Right. So Aditya Agare asks, would we end up paying more interest in the long run if we take this moratorium?
Yes.
Yes.
Why long term, short term?
Ankit Kumar asks, legal remedies during force majeure to avoid penalties from not being able to pay EMI. Sanjay?
Yeah. Sanjay, you have a
Yeah.
view on that?
Actually, yeah, not my subject legal, but I'm not sure how much of this will be force majeure, non-force majeure, and can anyone really take an alibi under force majeure? Very difficult to answer. Not, I think you should check with your lawyers and then take a call on it. And again, some of this also will depend upon the individual credit agreement which you will have with the lender as well.
Alok?
Yeah,
What
I
if
think the only
someone?
other element is, the credit business, while it is governed by the mutual agreements of the borrower and the lender, and to that extent, as Sanjay mentioned, lawyers might be able to advise on whether the force majeure is applicable or not. But there is a whole reporting side to the credit business, right? And it will still be the obligation of lenders to report the account on its performance, which does mean that regardless of what happens on the force majeure issue, your account will show up as delinquent, and it will compromise your ability to access credit in the future, right? So the reporting obligations of banks and NBFCs are actually again governed by RBI and mandated by RBI, and are not subject to bilateral loan contracts between the lender and the borrower.
Right. Um, Shreyan Jain says, will moratorium impact on term loans with government subsidy when subsidy is lying with bank in other account in same bank?
So I think it's
And
a
no, go ahead, Sanjay.
sure. So no, I think it's a very specific question which probably one should take up with its lender. So normally it's account to account also moratorium which can be requested for. So technically, can the account be eligible for moratorium? The answer is yes. But again, it's upon the lender and the bank whether they want to extend the moratorium.
Okay. Alok, did you have a view on this?
No, actually, I'm not sure I understand the question fully. What is the subsidy against and so on? But I think it's too specific a question. Perhaps best to discuss with the lender. Yeah.
True. Uh, Kedar says, should availing the benefit under moratorium of 3 months be dependent on the balance tenure of the loan if I have the capacity to pay the EMI? Something similar.
Yes, I think the simple rule there is, if there is capacity to pay the EMI, then it's better to pay the EMI, so that the additional interest is not getting accrued. Uh, so that, in my mind, is largely independent of the tenure. If there is stress on the cash flows to pay the EMI, then the tenure calculation and what does that mean in terms of absolute amount to be paid back, that starts to kick in.
Right. Nikhil Maheshwari asks, is it beneficial to go for the moratorium knowing that interest will still be charged? And if I want just a window for 1 month instead of 3 months, can I do it?
I think we have
I think
answered
we
that
covered that.
question. Yeah.
Yeah.
Ankit Agarwal says, does this offer relaxation to business OD limits?
I think again, it's covered when we discussed the OD limit is part of working capital.
Right.
So it gets covered when the banks are talking about interest on the working capital as well as increasing limits.
So Mahadesh asks, although it's not for this, okay. Significance of 3-month moratorium period over the loan borrowers for housing and services sector. Anyone wants to try that?
Hello?
So largely the implications are similar, right? So housing has this whole long tenure issue associated with it. Now it depends on what is the income that was driving that housing loan, right? If someone is a salaried individual, they still have their job, their income generating capability has not got compromised, then there is very little merit to postponing that loan and incurring the additional charge. Um,
Right. So Prabhakar Rao says, during the moratorium period, interest is added to the principal every month, or after 3 months only interest is added to the principal? Is EMI revise after 3 months or tenure is increased?
So these are all, lender to lender policies. The tenure will increase at least by 3 months just by virtue of the EMI getting pushed back. However, the incremental interest is being built into each EMI by some lenders, whereas some lenders are capitalizing that and then increasing the tenure, increasing the number of EMIs, in fact, which increases the tenure beyond the 3-month period.
All right. The next question is by Vinay Rajagopal. Why can't banks give 3 months moratorium as a part of their contribution to the society? Why can't you do that?
I think we
So
answered that. There was
the
a
same
question,
question
right?
of, should
Yeah.
the milkman give me the milk for free as a contribution to society? The
Right.
reality is that, these are tough times, right? And all of us, in our own ways, are doing things that we think can help, the nation collectively tide over this. Whether a moratorium interest waiver is the right mechanism to do that and whether a corporate entity is the right entity to do that are questions that can be debated. But I am very encouraged with how broadly, individuals and businesses are coming forward to make whatever contribution that they can toward fighting the COVID situation.
Right. So another question which says, does the 3
In fact, I
month?
was going to say that bank.
Yeah, please.
No, sorry, I was just going to say that the banks, by providing the services continuously, right, that one part of social obligation they are anyways meeting in terms of essential services. I think kudos to them and kudos to many others who are doing this.
True. True. Uh, Next question says, does the 3-month period involve all lenders, NBFCs, and shadow banks, or just big PSUs and private banks?
It includes all RBI governed entity. So NBFCs are covered by that. Having said that, the notification does clearly state that this is the prerogative of the lender to figure out which customers they want to extend the moratorium to or not. So different lenders may have different policies on how to implement the moratorium, but it does cover public sector banks, private sector banks, and NBFCs.
Right. How to ensure with a bank that the deferred EMIs of 3 months are not recapitalized with the principal outstanding?
So that, as I mentioned earlier, different banks are taking their policy decisions on this. It is unlikely that, at least for their large mass of customers, they're going to negotiate on this on a case-by-case basis. Larger corporate accounts can have that conversation. However, in most cases, banks are interested in having a standardized mechanism because they're dealing with very large volumes on this, and they would also like to make sure that all of these can be implemented easily on their systems rather than to create too many exceptions.
Right.
I think prepayment as an option will be available. So if there is a prepayment thing, people can go for prepayments as well later on.
Right.
Yeah. Normally with prepayment, there are some charges associated. Most lenders, again, that we are speaking to are waiving of prepayment charges in wake of the crisis.
Rahul Jain asks, is it compulsory to give moratorium of 3 months? Can the borrower ask for moratorium from April 1 to June 30th?
No,
I think the window is
so
till May, right?
the period of moratorium is 1st March to 1st June. Now,
Right.
within that, someone can take a two-month moratorium and not necessarily the full 3-month moratorium. But the moratorium is not an entitlement that can be shifted to any time period. So this is a limited window that has been created by RBI.
Right. Subhash Mehta says, will the 75 basis point reduction by RBI reflect in the OD interest we pay to our bank? Okay.
So I think some banks have gone ahead and reduced their repo linked rate as well. So again, it's going to be lender to lender. It won't be a general answer for everyone. But some banks I've heard they have reduced their rate, and probably that should reflect also in some of their products, including the OD product as well. But yeah, you should check with your own respective lender.
And again, that is something which is mostly independent of the moratorium issue. The two things are quite unrelated.
Right. The next one is a little specific. So it's from Hanisha Verma. Says, if I defer payment on loan for my loan outstanding amount of rupees 20 lakh personal loan at 12% EMI, how much EMI amount would be charged? The second part is, I have a credit card outstanding of 2 lakhs. How much would be interest?
So
On the
very
first
specific
question,
question.
go
Sorry,
on, Alok.
Sanjay, go ahead.
No, please go on.
So I think very specific questions. Different lenders compute these things differently, and so the lenders would be in the right position to be able to answer those questions.
Ajay?
Yeah, so I think so for a specific amount, lenders are the best because they should be able to work out the cash flows based on what they have computed. But if you want to work out a high level max, you know what is the interest rate on your loan for 3 months. If you're going for a moratorium, that 3 months interest anyways is an incremental stuff as compared to your normal cash flows in terms of your repayments, right? So on the incremental amount, you can easily work out the 12% and broadly your amount with few 100 rupees or 1,000 rupees here and there, which should probably change it. And on credit card dues, again, it depends upon what kind of category your credit card is in. And if your bank has decided to levy that particular rate of interest, which applies to your credit card category, then that's what's going to apply to on the credit card as well, unless they have reduced the rate of interest specifically as part of the moratorium.
Right. So Rakesh Bansal says, if there are overdues of 60 days past due of 1st March 2020, will they become NPA on 1st May 2020 if not cleared?
So as of now, the moratorium and all those rules apply only to installments which are due from 1st March 20 to 31st May 20. Given this amount is overdue already as of March 20, the general view is that, and the interpretation is that the asset classification norms will apply, and hence this account, if not serviced or that particular overdue is not repaid, then it can get converted into an NPA in 30 days time.
Right. Ankit Bajaj says, my account is SMA 1. The bank is refusing to provide moratorium. What should I do?
I think
So,
we will
I've
answer
mentioned this
that.
earlier. Most lenders are, open to collecting that one EMI and providing a moratorium, but the account has to get into a current state as of 1st March for the moratorium to be available at all.
Sanjay?
No, absolutely. I think I'll go with what Alok has said. I think the only option is you can approach your bank, regularize your account, and then ask for the moratorium.
So I think we've already answered that, but nonetheless, Prakash asked, what happens to asset classification status of a borrower already in SMA 1 or SMA 2 category as on March 1, 2020? Does it change in this moratorium period, or it remains the same till the end of the moratorium period?
I think we already answered. As of now, the view is it will change. So the asset classification norms will apply for all overdues as of March 20, unless if RBI comes up with any further clarification later.
Right. One of the last questions that we can take today is, what if I pay my interest of these 3 months at the end of this 3-month period? Then it won't get capitalized. Is this a better option?
So this I'm assuming is on a term loan, because on working capital you anyways have to pay the interest at the end of the moratorium. And on the term loan, as we said, if you have incremental or excess cash or a cash which you are able to repay, if your repayment capability is there, I don't think there should be any distinguishing factor between whether interest should get paid, principal should get paid. You should just pay the interest rather than any kind of interest burden coming to you.
Hello? Any thoughts on this?
Yeah, and again, I will defer back to lender-specific policies on this. As to how the lenders are capitalizing, would they treat this repayment at end of 3 months as a prepayment? So I think there are lender-specific policy questions here that should be checked with the individual lender.
Right. So the last question from my side probably would be, what is your view on how long this crisis is going to last? Because how long it lasts will be reflected on how much people can pay, how quickly businesses bounce back. Without that, where is the semblance of normalcy? What according to you is it, guys? Sanjay?
Well, it's a guess as good as anyone's guess right now. I think all of us are seeing what's happening around the world. Uh, it's something which all of us have seen for the first time in our life. Vaccination is still not available. Even if something is going to be available, it's going to be in the distant past. And there have been conversations around a partial lockdown or the lockdown opening up in measures or in regions, etc. Right? So it's something very difficult to guess. I think, of course, it will have a good impact on the economy. If the lockdown gets extended, then definitely the impact is going to be much more. Uh, a very difficult question for any one of us to answer here, but yeah, we need to be ready with both the situations. If the lockdown opens up, what is our action plan going to be? What we need to do? And if the lockdown gets extended, then what probably we should do? I think we need to have our backup plans ready.
Right. Alok, lenders
Yeah,
always.
so I can again share some of our experience of what we are doing to assess that impact. And a lot of that is based around scenario planning. We don't have a crystal ball to say when is this going to end. But the couple of scenarios that we are looking at is one, look at a 3 month. So let us say these lockdowns in part or in whole continue for till June, right? And then the economy starts to come back on track progressively. It might take 6 months, 9 months to get there. The second scenario we're working through is what if this progressive lockdowns continue till September, and then because the cut is much deeper, it may take 12 months for the economy to come back to track from there on. And then what we are doing is to look at the industries from which our customers come and be able to say how are those industries likely to behave through these periods. So businesses that are in the essential services space may behave differently than in discretionary purchase, for example. Right? So be able to project that disruption. And there is a fair bit of research. I think KPMG has published, some research around how specific industries may get affected, how deep the cut might be, how long it may last. So I would urge entrepreneurs and business owners to do scenario planning of that nature, to at least start to understand, the boundaries of, what we understand today. Right? There are no guarantees that one of those scenarios is going to play out. There's no guarantee that can't be worse. But at least it starts to dimension what the situation might look like, what the working capital needs might look like, how much is the impact on P&L of the company. So it starts to give you some range in which to work.
Great. Thank you, Sanjay and Alok. I think that's all the time we have. We have overshot our time by a few minutes, but these are, like I said, unprecedented times, and this is not a scheme that you would have had on a normal day and a normal economic cycle. Like all our panelists have said, we still do not know where the bottom is or how things will pan out. We can only hope for the best at the moment and keep social distancing. That is why we've done webinars. That probably is the only way to minimize risk and get over what we are currently facing. Thank you, Sanjay. Thank you, Alok, for taking the time out and taking our readers through the scheme. We hope it's been useful for our viewers.
Thank you,
guys.
Prem.
Thank you, everyone, and stay safe.